Welcome to the only technical analysis video that you will ever need. I wasted years chasing every holy grail, Wyckoff schematics, Elliott waves, Gann angles, you name it. I even fell for the ICT's secret algo cult until I noticed it was just recycled concepts from the Wyckoff, Elliott waves, or whatever the ICT got his hands on. A lot of it is repackaged supply and demand, and I used to be infected by that ICT mind virus. And hopefully, this video can get you out of that rut, can get you out of that mindset that there is an algo that controls the whole market. There are different algos that big money, the smart money, the actual smart money uses. But that's beyond this video today. The whole point is that I went back to basics from where I started. Simple support and resistance, highs and lows, simple trend lines. And in this video, I will show you that that's truly all you need. Because if you start piling on everything and anything you learn about price, you might find yourself within analysis paralysis. More lines doesn't really equal more conviction. It actually brings more confusion to your understanding of price action and what trading is really all about. Because at the end of the day, trading is about making money. All it matters that we take the trade according to our plan. And really, the real breakthrough is when we realize that deleting everything and forcing ourselves to read raw price is really the answer to all of our problems. Don't look for the answers in somebody else. Don't look for somebody else's signals. Don't look for somebody else's analysis. You need to be your own leader because trading is leading yourself with discipline by following your plan day in, day out. That's truly the only way up that I'm talking about. First of all, we need to understand how to read the chart properly and what is really important on the chart. Focus on raw price action, not predicting magic. Price really reveals everything that you need to know about the market, about how the price moves. It's really that simple. When we simplify everything, you start to see clearly again. So strip away every indicator and start with raw candles and try to understand what is the story behind the candles. Because the chart is a battlefield. It's a battlefield between buyers and sellers. And if you still got that ICT mind virus lingering in the background and trying to tell you like, oh no, that's not buyers and sellers, it's not supply and demand, then what is it? Do you really think that there is a button that you can push and suddenly the market goes to the exact point and then reverses and then goes to the next point? There is no such a thing as pre-programmed price action because the price action is the outcome between buyers and sellers, is the auction. And if we can accept that simple truth about price, that it's really no way to predict the outcome of the auction until it happens. We might anticipate the outcome of the auction between buyers and sellers, but ultimately we can't really predict it with the 100% accuracy because we don't see the future. So accept that the market is going to do whatever the market is going to do because you don't have enough money to move this market. You don't have enough money to push the price to that high that is your target. You anticipate price going to that target. But ultimately, buyers and sellers, the battle between them, that outcome is ultimately unpredictable until you can see it on the chart. So, yet again, there is a distinction between anticipation and prediction. We don't predict, we anticipate. And when the price presents the things that we like to see, our setup, our edge, when it bounces from the support, when it rejects from the resistance, that's our clue that we can react based off. It's like a paradigm shift. And you start to see how the market forms highs and lows, forms that structure, because all we can rely on is structure. We can't rely on the news because news might be manipulated. You never know how the broad market will react to the news. Just as a prime example, when everybody thought that the market's going to decline because Trump bombed Iran, it did exact opposite. It rallied and broke the all-time highs. So our ultimate goal here is clarity, because with clarity we will have confident execution. If you can keep it simple and practice your edge, practice your setup that you like to trade, you will find confidence in that simplicity, and it will be easy for you to execute, because the ultimate goal of the trading is making money in the easiest way possible. It's not that complicated. You either buy or sell and then take profit, or you get stopped out. It's really that simple. Don't overcomplicate it, because trading itself is simple, but traders like to overcomplicate it. Let's talk about highs and lows, which is really a market structure if you think about it. I used to think that it couldn't be this simple, right? It couldn't be as simple as tracking highs and lows and positioning within the boundaries of market structure, because every swing high and low is a vote by buyers and sellers. Like I said, it's a battlefield. The market moves by forming highs and lows, creating the battlefield for the buyers and sellers. So when the market moves to the high, there are sellers that defending that price, creating resistance. And when the market moves to the low, there are buyers defending that low, creating support. So by connecting highs and lows, it will reveal support and resistance. And if you think that it's more complicated than this, let me save you years of struggle, because, like I said, I studied mostly everything out there about the price and how the market moves and how to take advantage of it. And I really went back all the way to basics. And when you realize that simple truth, that everything is so simple and we just make it complicated, everything unlocks. Suddenly, trading becomes very easy. And I don't want to say that trading is easy, but reading the chart and analyzing the chart is easy. Trading in itself and making money with trading is hard, because we have our own psychological biases, and we need to go on that journey of discovering ourselves. And I want to save you time with this video, because instead of going on the journey of trying to figure out all the intricacies about the market, how the algorithms works, what are all the mechanics about the market, that's irrelevant. That really doesn't matter. Why the market moves doesn't matter. How the market moves matters. So instead of trying to find the reason for the market move, accept the simple truth about the price, that it's highs and lows. And market simply moves between highs and lows. Market constantly creates higher highs, higher lows, lower highs, lower lows. That's all it is. Let's not complicate this, because it will send you down the rabbit hole and you will never be able to get out of it unless you go back to basics. So I've been there, and I'm telling you, you don't really want to be there. You don't want to go down that rabbit hole, because it will set you back years, just like it did with me. I wasted years and years studying this nonsense, especially the ICT. And a lot of my drive and passion for this industry comes from fighting against the ICT mind virus. I really think that he's detouring traders. And there is a huge detour where you go down the rabbit hole of the ICT algorithm and trying to decode it, trying to find the holy grail enigma that doesn't exist. So let me save you time, which is the most valuable asset in the world. If you truly want to understand how price moves, how, not the why, how, you need to observe and pour yourself into observing how price moves. Don't try to figure out why price moves. Try to figure out how price moves and how can you position yourself within the price action. And instead of going down the rabbit hole of trying to figure out the why behind the price action, go down the rabbit hole of self improvement. Try to become a high performance athlete. Treat your execution as a sport, as a competitive sport. But you're not really competing against other traders. You are competing against yourself. So when you're deciding to spend your most precious asset in the world, time, spend it wisely. Spend it on the things that matter, which is your execution. The chart reading is easy, but your execution is hard. So in this video, I will answer all of the questions about how the price market moves. I give you a little bit of why in the beginning of this video, but really it's all about how price unfolds, how price moves from support to resistance, and how can we position ourselves within the market structure. Because these zones are battle lines and roadmaps for future price. We anticipate the price following from support to resistance back and forth. And sometimes the price will break out. And that's the start of the trend. So, breaks and retest of structure signal power shifts. So, what we anticipate is price range and then a break and retest of that range, and we anticipate the trend unfolding. So, trade the reaction, not the prediction. And that brings me to the consolidation expansion cycle. Because really, truly, if you study price enough, you will realize that there are only two market regimes. Price either consolidates in a tight range or price expand into the direction. And really what it is, it's all about balance. During the consolidation, market within the balance, buyers and sellers kind of agree on the price. They agree on this price range by creating support and resistance. So when the price moves towards the support, buyers defending that line, that's their last line of defense. And then when the price moves to resistance, there are sellers that defending that price. So by definition, it creates a range. It creates consolidation of price. So there is a constant battle going on between buyers and sellers establishing this ranging price action. And when the price breaks out of the range, that's your signal that one side, buyers or sellers, won the battle. They won the battle. And now creates a huge imbalance because now that everybody sees on their chart that the price is breaking out, it creates FOMO. Everybody's looking at the price and they see the breakout. It's obvious because everybody's looking at it. So this creates a self-fulfilling prophecy. The more price trends in the direction, the more it attracts buyers, creating momentum. So this is where the price might consolidate for a long periods of time, and then suddenly when it breaks out, it just skyrockets. This is the FOMO in real time. People, traders, big traders, institutions, big money, banks, everybody sees this on their chart. And the more money they have, the more conviction they have, the more they will pile on onto that rally, creating the trend. So, right as it breaks out, we have an explosion in momentum, which creates a velocity. The price starts moving with speed. There's certain momentum attached to the trend. You can measure that momentum. You can measure it with volume and anticipate more and more volume on each higher high or lower low. And when you see the volume slow down, when you see price making higher highs, but the volume starts to decline, that's your signal that the momentum is slowing down. It doesn't mean that the price is going to reverse. It means that momentum is slowing down and there is no more new buyers or new sellers coming in to support the trend. So when the volume slows down and there's no more buyers coming in, price will start moving sideways again. So the price goes from consolidation to expansion and back to consolidation. Price goes from balance to imbalance and back to the balance. So if price moves from consolidation to consolidation, that means that your target should be within the previous consolidation. And really, your trading edge is anticipation of the next phase. So when we see consolidation, we anticipate expansion. So when we see expansion, we anticipate that at some point, price will start to consolidate again. This is giving you clear rules on when to enter and when to take profits. So we're going to keep this simple, and this is all we're going to use in order to mark out the market structure, highs and lows, the ranges, and the trends. We want to use horizontal lines around tight price clusters, which is the consolidations, the ranges. They are very obvious on the chart. You have ranges on the higher time frame, you have ranges on a lower time frame. Later in this video, I'm going to get into the live examples and show you exactly how to do this. But first, we all need to agree on the simple way to mark out the chart. So all we're going to use is horizontal lines for the support and resistance, marking out the ranges. And in order to mark out expansion, all we're going to use is simple trend lines. One of the rules that I like to use for the range breakouts is the candle closure outside of the range. You want to pay attention if the candle closing outside of the range, because that will signal that we are breaking out. And then we can monitor the break and retest in order to get in on the retest of the range to catch the expansion. And the first target that we can use immediately is the range height. How big is the range? And all we do is just measure a projected move, which is the height of the range, the height of the consolidation. The goal here is to keeping chart minimalistic. Really, the price and simple lines are enough for you to understand what is really going on the chart. All right, so with that being said, let's take a look at the real chart and we're going to put this all into practice. So we got gold futures chart, GC symbol. This is yearly chart. Each candle is 1 year. And here clearly we can see that this is consolidation, expansion, consolidation, and expansion. So market moves from consolidation to the expansion, goes sideways again, consolidation, and to the expansion. Before you do anything on the chart, you want to start with the top-down analysis, because largely these higher time frames are going to be in control. As you can see, currently gold has been going on higher and higher with each year because we broke out of this consolidation that we were in since 2011, and we finally broke out in 2024, and now the gold is going higher and higher. Currently, this is the trend line that we are following. And don't try to treat this as a science. We're just marking out the obvious trend line because what's obvious in technical analysis, usually that's what works. We can also mark out this trend line over here, and this is on the yearly chart. So let's go to the monthly chart, and we're going to go down the time frames one by one and see what is going on. So by going down to the lower time frames, we can start refining these higher time frame trend lines. And in order to draw a trend line, you just need a higher low. So here was a higher low as well. So that's a trend line. Was obviously a level of resistance. Price breaks out and eventually flips this resistance, and this resistance became support, as you can see over here, and price went higher. So this is also here on this higher low is a trend line. So currently we can see that price is expanding higher and higher on the monthly chart. So we have consolidation leading to the expansion. So at some point, we will start consolidating again. And all of the gains were made on this expansion. If you bought it over here, you would be sitting in this consolidation for 12 years until now. Interesting chart on gold here, but all it is consolidation that leads to the expansion. And it's pretty obvious that this is the range and this is now an expansion. Very simple. Keep it simple. The more simple it is, the easier to understand. And logic is very simple. Use common sense because market moves from consolidation to the expansion. So what do we expect after the expansion? We expect consolidation. It can still keep going higher, but at some point it's going to start consolidate. And we want to get in on the consolidation. So we want to buy either inside of this consolidation or we want to buy on break and retest of the consolidation. So here as well, this was consolidation, expansion, consolidation, and expansion again. So let's go to the weekly chart, and we're just going to adjust the trend lines yet again like this. And currently, we can actually mark out even this trend line over here. So even on the weekly chart, after we breaking this higher time frame consolidation, this monthly consolidation that we were in for a long time, for 12 years, we have the breakout and we still have consolidation. So this was consolidation as well. So you have higher time frame consolidation here, but this is also consolidation that led to the expansion, and we had another consolidation here. Just like over here, this was consolidation that led to the expansion and to consolidation. So now, because we broke out on the higher time frames as well, this led to the higher time frame expansion, and we entered price discovery. So nobody knows when this trend is going to stop, but at some point it's going to stop. The first sign that this trend is going to stop is the break of the trend line. So at first, we're going to break the lower time frame trend lines, and we're going to break the higher time frame trend lines, and then we're going to the higher time frame trend line support, and at some point, it will bounce, right? This is just a simple plan. How can we anticipate and what can we anticipate after the expansion? Another thing is that after the trend line is broken, it doesn't mean that it's immediately going to go down lower. It actually means that now price is likely to enter another consolidation, and eventually that will lead to the expansion. Now, this consolidation doesn't have to lead to the downside. Could be the reaccumulation or whatever you want to call it, but usually consolidation means that the move is pending. The price is gathering fuel for the next expansion. This could break out lower or this could break out higher. So let's go to daily chart, and we're going to keep going down the time frames in order to spot a trade. We want to do the top-down analysis all the way from the highest time frame to the lowest time frame, the one that you are trading, and this is how you can find potential high probability trades. So you can see as well over here, consolidation that led to the expansion. Now, this is a trend line here, right? There is the trend line. And let me remove this one that's coming from the higher time frame, because you can see that by marking out a higher low, you can expect this trend line to act as a support, right? This is after the expansion. Now, we also have this trend line like this. So remember what I said, after the trend line is broken, we expect consolidation. And was another consolidation, and finally expansion unfolded. This is also consolidation over here, and expansion unfolded. Hopefully you can see the cycle. You can see the repeating nature of the market, where we have consolidation leads to expansion, into the consolidation, into the expansion, into the consolidation, into the expansion, into the consolidation, into expansion, and now we are inside consolidation. Now, yet again, this consolidation does not mean that we going to start going lower, and it doesn't mean that we're going to start going higher. As traders, we don't really want to predict because we are not analysts. What I'm doing right now is describing the nature of the market. I can say, well, the gold looks like this is accumulation, this is reaccumulation, and we're going to go higher. That's not what I'm doing. I am trying to find a trade inside the chart. And with the trend lines and support and resistance, we can position ourselves at the best location on the chart. How you structure the trade is way more important than your prediction. This is how you structure your risk. You always hear risk management is the most important thing for a trader. Of course it is, because trader cares about protecting capital. Trader doesn't care about being right. And that's the main distinction between a trader and analyst. And if you want to make money trading, you want to be a trader. If you want to work for a trader, choose wisely who you are. Because you can be making money as an analyst, analyzing the market, providing your predictions, and working for the traders. Or you can be a trader who is trading the market. So your job is not to analyze. Your job is to position yourself in the most favorable way that you can. So let's keep looking for the trends. We have this over here. And another caveat, another gem about the trend lines is that when the price comes into the trend line, it might look at first that it's breaking the trend line. But then you can notice there is a range on the lower time frames, because we just coming off of the expansion into the consolidation. So consolidation at the trend line is a good thing, because you can anticipate a bounce from the trend line because this trend line has been proven as a support. So another thing about trend lines is that after this move occurs, you want to adjust the trend line to the latest low because the trend is still working. As you can see over here, after this adjustment, price came precisely to the trend line. Yet again, we had a little consolidation here, and then price expanded again. So now, currently, we are being in this range. And you can see that price just came down to this trend line. So there is a possibility now on gold that we might expand higher. If this trend line fails, then I would be anticipating, not predicting, I will be anticipating break and retest and move towards this trend line. And by creating these trend lines and by drawing them from higher time frame to the lower time frame, you will create a map for the price. And I encourage you to backtest these trend lines. I encourage you to go into your chart and whatever you're trading. I like to trade NASDAQ, but gold is such a great example here that you can see easily how one trend line, this daily trend line, could be respected for the multiple times. And each time the price comes into the trend line, it's a trade opportunity. So these trend lines are no joke. And the more you study them, the more you're going to understand how the price actually moves around these trend lines. Because if we understand how the market moves and why it moves, which is supply and demand, with buyers and sellers, and I'm not talking about your little $100 trades. I'm talking about big money, big banks playing games, right? Who's going to be on the right side of the market? And that creates movements within the markets. We all looking at the same chart. So when the price coming to the trend line, when the price coming to the support, like over here, we have confluence, right? We have many people buying at this support, buying at this trend line, and it creates a self-fulfilling prophecy where a lot of people doing the same thing, and that's why the market pushing up. We're not really trading the markets. We are trading the collective behavior of the people. This is all about psychology. Once you understand that, you will realize that these trend lines work because everybody can see them. Everybody making a decision when the price goes to the trend line. So currently right now, as you can see, we are stuck in this range. So let's mark out this range. And I like to mark it out with the last candle. This is where the resistance became support. And this last candle is acting as resistance. So currently we are in this range. So this is also a last candle here. So this is what we're really working with. We got the support and we got the resistance. And the price moving in between support and resistance. So let's go into the lower time frames. Let's go into the hourly time frame. And let's see what has been happening here on the hourly time frame. There was that high over here, and we're just going to draw the trend line. There it is. And like I said, we want to adjust it to the last obvious high. We can clearly see that once the price hit this daily support, we had a little accumulation range over here. And after this accumulation range, we had an expansion, and now it's back in the range. So we still ranging here on the gold, and now the price is creating this larger range. So we can anticipate a reversal at the trend line if we can look at the momentum. One thing about momentum is that when we see lower volume on the lower low, right at the higher time frame trend line, That's our clue that the price might reverse. We can combine this with the RSI. This is regular RSI with default settings. And you can see that there is a bullish divergence, meaning that the RSI is going higher while the price is going lower. So the lower volume with the divergence is the signal of the reversal. But we need to look at this only after the price is coming to the higher time frame trend line. So we had this expansion and then price got into another range. And look at it again. We have higher high with the bearish divergence and a lower volume. I'm going to highlight there is the volume of this high and there is the volume of this high. You can see this slowdown. You can see there is not enough volume to push this higher. And that's why price reverse. And now we are inside of this bigger range. And yet again, we're marking out higher low. And after price breaks this trend line, you can see that price entered a range, like over here, right? So in order to capitalize on this trade, we can use break and retest with a target at the previous range, because price moves from consolidation to expansion to consolidation back to expansion, and the target is another consolidation. Because if you think about it, the market moves from consolidation to consolidation. So we want to catch expansion, but where do we exit? We exit on the trend line break, or we exit at the previous consolidation. This is the common sense trading. I'm trying to keep it simple, and we only using trend lines for the trend and support and resistance for the consolidation, for the range. So currently, what do we see here? Just like we saw over here, low, lower low, higher high, higher low, expansion. This was a setup. So now we can also see over here, look at this, low, higher high. So we can expect a higher low. So if I were trading this time frame, I would be looking at the 618 retracement. I talk about this in the previous videos. This is just a basic retracement, which is we got consolidation, expansion, and we retesting this consolidation because technically this consolidation is unmitigated. And now we have this downtrend over here, right? So the setup would be if the gold moves above this consolidation, right? Retesting the trend line, retesting this resistance that's going to become support, and it moves higher. So if you believe that this trend line, this higher time frame trend line that's coming from the daily chart is going to hold, you can buy it right now. Set your stop loss over here because technically we made a higher high. We have retracement, and this is a start of the expansion. The other option is to wait for more confirmation, right? Is to wait for the price to get above this resistance and enter on this retest. Now, there's different types of retest. Usually there's two. We got the retest on the top of the range and retest that goes deeper into the range, just like we have this retest of the higher time frame range. Because we broke this high, we made a higher high, and this should be a higher low. If the price decides to keep breaking lower and breaking this daily trend line, which is now should be adjusted, right? Now this trend line that's coming all the way from down here, let me see where it is, all the way from down here, right? Should be adjusted to this last low like this. And now, if the price keeps breaking below, what we can anticipate is the break and retest of this big range. So this is the big range. And if price breaks down, break and retest of this range and continuation lower, down into the support, right? This green area is the support on the higher time frame. And if we give up that support, it should move down to this trend line over here. And all of these trend lines are coming from the higher time frame. Hopefully makes sense, but the more we zoom in into the lower time frames, the more confusing it might get, but also we will have the boundaries for the trade. This is the structure of the market. And this is the same pattern that I was talking about in my very early videos about market structure, which is you have lower high, lower low, and then price eventually makes a higher high, and we can anticipate retracement into the 618. This is also could be retracement into the 50% of this previous swing, right? So there is the 50% of the previous swing. And in my opinion, the gold is bullish. This is the hourly chart. This works on all of the time frames. This works everywhere. So let's go into 5-minute chart and let's see if we can find intraday trades after the bounce of this trend line. So this happened recently, and I actually called this trade out on my Twitter profile on X at Stoic TA. Follow me there. But we have the same thing going on here. We have this simple pattern. And in this case, this was a retracement on top of the range. We're going to adjust this trend line here. The same thing, we have lower volume. We don't really see the divergence on this low, but it's still a divergence on the higher time frame. We can use that as a confluence. So yet again, we can mark out a high and a low over here. So that's the range we are working with. This is also a concept for the support and resistance here. This used to be resistance. After price breaks out, comes back to test this resistance that now acting as a support. So eventually price breaks out. We have a retracement over here. We can also use the trend lines. Well, first of all, let's start from here, higher low. After price breaks a higher low over here, it has one more push, but it enters consolidation. After expansion, we expect consolidation. And after this consolidation, we expect another expansion. Very simple. So this is where the price end up bouncing from. We just want to adjust it. And also, if we draw the trend line from here to down here, the same thing happens. After the expansion and a break of the trend line, we have consolidation and expansion higher. The same, look at this low. Used to be resistance, becomes support. With the trend line confluence, with this confluence of the support that comes from this high, it's the same thing. And we have the same pattern. Lower high, lower low, higher high, higher low, and price expands. And this was also a 618 retracement here. Even on this lower time frame, probably you can see it on the 1 minute. You can see lower high, lower low, higher high, higher low. Price continues to go higher. And this repeats over and over and over again. So let's see where this trend line is going. So we have expansion, beautiful expansion, and you can trail behind this expansion, right? And boom, we break the trend line and start to consolidate. Consolidate, consolidate. We keep consolidating. consolidating. This is now a big consolidation here, right? But eventually, we had this consolidation, right? We break the trend line, we enter this consolidation over here. And what happens? We have a lower high, a lower low. Was a double bottom. And we have a higher high, retracement, and expansion. Now, sometimes this is what you're going to see after the breakout. This is what I call a swing breakout sequence. You can find the videos on my YouTube channel. This is my pattern that I have discovered, that I have refined, and I really refined it to just 5 steps. It's a breakout, number 1, first pullback, number 2, a new high, number 3, and then we come back to liquidate number 2, which is 4, and the 5 is a reversal. Usually looks like a double bottom, as you can see over here, double bottom, and continuation and actual expansion higher. So yet again, we can draw the trend line from here to here, and we would be out of the trade on the trend line break. And we keep going from expansion to consolidation. There it is again. We entered consolidation here, right? This was consolidation. We have a lower high, lower low, higher high, higher low. And you can see again that swing breakout sequence. 1, 2, 3, 4, 5, expansion. So now you can see this is a bigger range here, right? This one over here is a bigger range. And what happened? We break below, we come back to test it, and we break lower. We have another consolidation here. We break above, a little retest, and expansion higher. Yet again, consolidation, break, retest, expansion. And what do you think is happening here? Consolidation. So hopefully you can understand how to read the chart, because really there is only 2 cycles. We moved from consolidation to the expansion and back to consolidation. And price moves from consolidation to consolidation. And the money is within expansion. So I encourage you to backtest, go into your charts, and with open mind. Don't try to be like a scientist. Think about people making decisions. Think about if you had millions and millions of hundreds, billions of dollars, what would you do? What would you do inside of this range? What would you do on the higher time frame? What would you do when the price comes to the trend line? Would you think differently? Would you just jump in because price retraced into the FVG? Anyway, if you want deeper breakdowns, if you want a step-by-step process on how to build your own trading system, not just a cookie cutter trading model that you can trade anytime, anywhere, and it's easy. That really doesn't exist. It's the very first step to understand trading is to pick a trading model and master it. But the more you have screen time, the more you learn about the markets, you realize that it's all about positioning yourself within the market structure and following your system, and the emphasis on your system. And that's what I teach inside of the Stoic Traders community. You can check it out at stoicedge.com. I also have my live trading recordings of my trades, and I explain all of my thought process every single week. And with that being said, always remember, the only way is up.